A very good afternoon, good morning. Welcome to HYCM's live trading workshop with myself, Giles Cochran. I do hope everybody is well. A very good afternoon to you, Esther, Rick, and just as other folks are coming in, just to outline the different currency pairs, indices, commodities that are moving at the moment. Looking forward to just informing folks what exactly is going on in terms of global sentiment and understanding some of the wider macro moves. Don't forget that this is not trading advice. The whole idea of these webinars is that these webinars are from an educational perspective. So you can see how someone like myself with a professional trading background goes about making trading decisions. So the special workshop topic today is what's the trade after the Reserve Bank of Australia meeting. So the Reserve Bank of Australia met today. I'm just going to run through what's going on with that and where we're at in terms of that meeting. Now, this is on the blog, so don't forget to go to HYCM's blog here. I'll just put the web address here in the chat box. So if you haven't seen the web, you can it's just in the chat box there. You can just go along and check it out. Now, the Reserve Bank of Australia has been grappling with a few things. So commodities have been gaining across the board. If I just show you the pressure that's been on the Australian dollar, you'll see that in a minute. Just take a look at this commodity chart. Now, some of the biggest exports from Australia are iron ore and coal prices. And you can see that iron ore prices were surging through COVID-19. They've started to pick up again. Coal futures have been surging. They're dropping a little bit lower now. But that's been really supportive for the Australian dollar. On top of that, we've had various headlines out of China that China's central bank is looking to cut interest rates. We've had China's government saying they want to keep Chinese stocks stable. Chinese stocks have fallen. This is the A50 index, and you can see that the A50 index has fallen, 40% since last year's highs. This has got the attention of China's government. And unlike other central banks around the world, China's central bank is looking at cutting interest rates. They want to make conditions more helpful for companies to try to halt some of these sharp falls in equity markets. Imagine if you were a Chinese equity investor, or maybe you've just been buying in, seeing the equity index fall 40, 50% is an obvious cause for concern. So that has meant that the Australian dollar has been having sort of reasons for upside, yet despite that, the Reserve Bank of Australia has been unwilling to hike interest rates. Now, if we just take a look at the decision, you want to look at these decisions yourself. And this is the RBA interest rate decision. You can find them on all the central bank websites. And what the RBA are saying is that they're beginning to see inflation. See, inflation has increased sharply in many parts of the world. They give three reasons for this. Supply side problems, that was due to COVID-19. You remember when people couldn't get supply of various goods, and even though services dropped through the floor because no one was going out, no one was meeting and socializing, demand for products rocketed as people were sat at home. They still had earnings, still had income, and people were buying products, but they couldn't be supplied quick enough. Those supply side problems resulted in inflation and still are doing. We now have Russia's invasion of Ukraine. We've seen disorderly moves in commodity markets, natural gas markets spiking higher. We've got the surge higher in iron ore prices. We've got the surge higher in oil prices. That's due to Russia's invasion of Ukraine. And all the energy needs that producers and factories have are increasing price pressures. And also there's still strong demand. So all of this means that inflation is heavily there. So the RBA recognize that inflation's there. But the one thing that they're focusing on is wage growth. So they say that wage growth has picked up, but they're saying, but the aggregate level is only around the relatively low rates prevailing before the pandemic. They say this pickup is still expected to be only gradual, though there is uncertainty about the behaviour of labour costs. Now, elsewhere, the Reserve Bank of Australia have said that they will kind of look at moving interest rates higher when they see the wage price index move up to 3.3% year on year. Now, the last print was about 2.4%. Now, inflation is currently at 2.6%. Now, if you notice, the board's target is 2 to 3%, but the underlying inflation is currently at 2.6%. So you might say, well, that's in their target. But what the RBA have been saying is that they want to see it sustainably, because they say that the inflation is due to, you know, supply side problems, Russia's invasion of Ukraine, strong demand, but not due to a kind of a big bounce and a good recovery from Australia, although that is expected. So this meeting, they kind of made a more hawkish move. So what they kind of said is that, yes, we recognize that we may need to be less patient. Now, let me show you something here. Here we go, right. Let me just show you here the interest rates. Now, if you look at the Reserve Bank of Australia, this is from some of my work with financial sources as an analyst. I use some of their excellent resources here on a day-to-day basis. And you can see that the probability, this is the Reserve Bank of Australia, there's now a 63% chance of a rate hike for the 3rd of May, according to the short-term interest rate derivative markets, the Stern markets. Now, if you look here, this is the implied interest rate curve. So they're expecting interest rates to rise from the current rate of 0.1% all the way up to over 2% by the end of this year. Okay, I'll just make that a little bit clearer and you can see it. So that's a very steep curve, but the Reserve Bank of Australia still hasn't said that they'll hike rates once this year. But for those of us who've been following this, this is, you know, the Australia government is expected to hike rates and have been for some time. So that's why I've been buying the Aussie yen, and I'm actually closed out my Aussie yen long because of these expectations. One of the things that you have to really get your head around is that professional traders, they are looking a long way into the future. So they've been looking at an expected recovery and expected response to rising inflation for quite some time for the Reserve Bank of Australia. Now, the next meeting date says 3rd of May, but we don't get the wage price index data until I think the 18th of May. So that means that the Reserve Bank of Australia, will they really hike before they've had the wage price index? I think that's unlikely. So we're in that sort of situation of game of cat and mouse. Now, what does that mean in terms of the Australian dollar? Well, let's just take a look at this. If you look at something like the Australian dollar CAD, let's just have a little look at this. It does mean there is an upside bias in the Australian dollar CAD. Now, the CAD has been sort of, you know, really quite overly hawkish, and whether they can maintain that hawkishness is not clear. So any retracement sort of back down to that 0.9350 can be considered suitable for going long in the Aussie CAD at the moment. Stops can be just put underneath the 0.9300. So you have an opportunity to potentially get into this on a long bias with quite a tight stop. So that is a potential trade idea in the Aussie dollar CAD as we move forward. But you can see some of those, you know, initial upside in the Australian dollar is just retraced a little bit because, you know, some of that enthusiasm has just died down, because a lot of enthusiasm, as you can see, is already priced into the short-term interest rate markets, with professional traders looking at the short-term interest rate derivative markets and expecting a series of rate hikes throughout this year. Now, that's the RBA interest rate decision, and always get to have it. Read interest rate decisions yourself. It's a really helpful tool to do, and really will be helpful for you. Now, in terms of what other major market events we need to look for what's going on now in equity markets. Now, this was, you see the drops that we're seeing in equity markets quite pronounced now, and you can see The Nasdaq, dropping quite sharply today. Now, the Nasdaq is very sensitive to rising interest rates. And if you just look at the Nasdaq, and if you look here, we'll look on the weekly chart. I've got the Fed funds interest rate here. So this is the interest rate of the Federal Reserve. Now, what you notice is that when the Federal Reserve hikes interest rates, stocks can still gain. But you look here in 2018, what happened is the Fed was hiking rates aggressively as growth was slowing. And so the Nasdaq saw this sort of around 25% fall at the time due to the Fed hiking aggressively, but growth was slowing. Now, if you look at the latest data we've had from the US, you can see that personal consumption, consumer confidence, personal income in the US, retail sales. Do you see how they're all ebbing lower? So you see growth is slowing. Particularly notice the University of Michigan sentiment. If you see how low that sentiment is, and consumer confidence is really dropping. Now, that University of Michigan sentiment is an important data point because it lets you know how the US consumer is feeling. And if the US consumer is feeling worried, then that is a good indication for some analysts. They really take that as a good indicator for potential recession. So it's too early to say, yes, a US recession is definitely coming. But this is what markets don't know. Is this like a dip in growth and then it's going to bounce up? Or is this a dip in growth that's going to accelerate lower? Now, no one knows that at the moment. But if you look at the data out of China last night, that's quite worrying with the CAC services PMI. To see how that fell down to 43, it was 42 overnight. So that drop in the services PMI, see there at 42, is really quite serious because it shows you that the private PMI data in China is showing signs of stress and underneath expansionary territory. Now, it's in contraction, and that's due to rising COVID-19 cases. Of course, Shanghai's on lockdown. We've also got Russian-Ukraine risk, and also the PMI private data noticed that input costs for producers are increasing. So there's pressure building. Now, that means, that if the Fed's hiking, as growth is slowing around the world, then we could expect equity markets to keep moving lower. And if you look here, you can see the Fed's about to hike, and the anticipation is that the Fed's going to hike by 50 basis points in May's meeting. And again, if you just take a look at the interest rate expectations for the Federal Reserve, you can see that the implied rate curve is that the Fed are going to be hiking, that is what, 8-9 times this year, up to 2.5%. So, and the next meeting is in the 4th of May, and expected probability change 83% for a 50 basis points rate hike. Now, yesterday, Fed's Brainard came out and said that there could be a rapid pace of quantitative tightening, which is the opposite of quantitative easing, as soon as next month. And that's what has got markets worried. So markets are worried that interest rate hikes are coming, and that's why we're starting to see downside in equity markets. That's also where we've seen a little bit of restrained action in China's 50 index as well. So that's what prompted the risk-off trading. Now, in terms of commodities are being pushed and pulled around by the Russian-Ukraine risk. Gold structurally looks very strong. Medium term, it has a buy bias, and it is possible to buy at market with stops below the low. If we start to see a stagflationary environment, that is a perfect environment for gold. Now, a stagflationary environment is when we see this. Let me just show you. I'm just going to make sure and get this out. Just one moment while I pull up the right chart. Okay, it's not wanting to Just bear with me. Trying again. I've got a bit of a problem on my end. Just see if it wants to come up. No, it's not coming up. But let me help you here anyway. The business cycle theory is when you get stagflation, which is high inflation but low growth, that is strong gains for gold. And if you just look here, we have a Harami false break inside bar. So you can see here, this is a false break of an inside bar, of a Harami inside bar. So you could buy at market with stops beneath the low. And if the stagflation environment really kicks in, it's not unreasonable to expect a retest up of 2050. So there's quite a decent risk reward there. Now, there are some problems with this position, and I'll just explain what they are. Okay, so the risk reward would be, let's say, 3 to 1, basically. So not bad. Now, the risk with this is that, I'll explain that with this chart. Now, Brainard's comment has just sent the dollar soaring, and it sent yields soaring higher. Now, 10-year yields tend to respond to growth expectations, and 2-year yields, the short end of the yield curve, tends to respond to short-term interest rate expectations. But the 10-year yields keep pushing up, even though US growth is slowing. That's what's not allowing gold to rise. If we saw 10-year yields drop, but inflation remains high, that would boost gold significantly higher. And obviously, if we saw the dollar falling. Now, there is this very helpful chart. Let me just help you find it. For some reason, annoyingly, some of my charts just got walkies. Great, I've got it. Now, if you look at this chart here, what you can see is that the black line in the middle of the chart is when the Federal Reserve hike interest rates. Now, the dollar tends to gain into the first Fed hike for the 6 months into it, and then it tends to fall for the 6 months out of the first Fed hike. So you can see 2022, 2015, 2004, 1990, 1994, the dollar gained into the Fed hike. And then as soon as the Fed hiked, we had a buy the rumor, sell the fact response, and then the dollar weakened out of the decision. So this kind of action is what we'd expect. So as the Fed's hiking aggressively, we would expect in time the dollar to weaken. Now, the problem is that the safe haven flows on the Russia-Ukraine crisis is causing the dollar to keep finding bids. And as we're coming into aggressive rate hiking, that's where the dollar is currently gaining on Brainard's comments yesterday, where Brainard is saying, look, we're going to have to maybe bring quantitative tightening into play as soon as this month, right? Next month, rather. That's why the dollar's broken out at 99.50. Now, it is suitable to go long at market here on the dollar index. Just put stops underneath the 98.60 region. But it is possible to see if that level breaks. From an intraday basis, you can have your stops just the other side of that S1 pivot zone, just underneath 99 for a tight, 30, 40 point stop. That's not unreasonable. Expecting a break and a bounce higher on Brainard's comments. Seeing this sort of break above that level is usually a very crucial technical figure. So that dollar strength is there. Just paying back a little bit. This is the pair to look at if we get a de-escalation in the Russian-Ukraine crisis. So say, for instance, Russia and Ukraine find peace talks. Expect the euro-US dollar to gain sharply higher. That's the one to buy. Now, let me explain to you why that is. If you take a look here at, let me show you. If you take a look at the euro, this is a basket of the euro. Notice how the euro weakened so sharply during the Russian-Ukraine crisis. That's because Russia and Europe are very close to one another, and they have some close ties economically. and many investors wanting to remove their euro holdings, and so the euro was weakening throughout the Russian-Ukraine crisis. Obviously, proximity of Europe and Russia means that investors got spooked and the euro fell. But if Russia and Ukraine make a peace, a long-standing peace, then you can expect euros to get back in to the eurozone. So that's definitely one to watch. And similarly with the pound also fell off, and that's due to proximity risk as well. And unusually, we saw gains in the Aussie, the New Zealand dollar, despite the risk-off sentiment. But that's because the Aussie and New Zealand dollar are called commodity currencies, and as the commodities were gaining, the Aussie and New Zealand dollar gained. And also, Australia and New Zealand is a long way away from Russia, so the proximity helped. So, investors were able to move some of their currencies into the Aussie and the New Zealand dollar. It's a long way away from Kyiv. Okay. So in terms of medium-term opportunities that we have, another medium-term opportunity that's worth looking at, but again is not without complications, is the euro pound. Now, the outlook between the ECB and the BOE is quite different. Now, if you look here, you can see the interest rate differentials between the 10-year yield and the UK 10-year yield has been pushing higher. Now, do you see how price tracks the bond yield spread? When the bond yield spread is falling, price is falling. When the bond yield spread is rising, price is rising. When the bond yield spread is falling, price is falling. You see? Now, sometimes the yield spread will lead or lag, but usually price will catch up with the bond yield spread essentially. Now, the outlook here is that we expect the ECB to have to respond to rising inflation now. They're meeting next week. So it's not unreasonable to expect euro pound buyers. Now, there's two ways into this. Where do you put your stops? One way is to enter at market with your stops underneath 0.8300 and look for a retest up at 8,450. That's a pretty nice risk reward. You can see that that's pretty good. You're risking 60 odd points and you're looking for about 100 points. So about, 1.5-ish risk reward, not bad. Or if price drops lower to that 0.8250, that would be a lovely entry with stops just underneath under 0.8200. The other way of looking at it is like if you want to have a bit of momentum on your side, you could wait to see for a trend line break. So you could look here and say, okay, that is a good enough trend line break. I could enter at market with my stops just underneath 0.8320. That's a potential turning point that you could be looking at there in the euro pound. Okay, folks, I hope that's been helpful, and I hope that's been a good kind of reminder of some of the key elements that are going on. Don't forget, on Monday next week, I haven't got my normal daily risk event outlook because I am away on holiday, which I'm very excited about. And I will be back the following Monday. I won't be back the following Monday because that's a bank holiday. So I won't be back on the Monday for 3 weeks now, because next week and the week after I won't be here. But I will be back on Wednesday week. So that is Wednesday, the 20th of April, I will be back. So thank you all very much for attending, and I hope you have a very good rest of the week, and I hope some of those trade ideas and thinking processes help. Thanks everyone now. Goodbye. Take care. Yeah, see you Wednesday 20th, Max. Yeah, you're very welcome for these webinars, Max. Really well. I really enjoy them. So just keep coming along, and I'll keep pushing out the information. Thanks, guys. Take care now. Goodbye.